AT&T drops its bid for T-Mobile and will have to pay a $4 billion breakup fee in the fourth quarter. Spain borrows over 5 billion euros at its latest auction with strong demand and low yields. And U.S. stock futures are pointing to a higher open, but can markets hold on to gains this time around? We're going to show you how to trade. I'm Alix Steel, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer at T3Live.com.
And I'm Alix Steel from the street, and together we bring you the morning call. Scott, help me make sense of this. Again, we're gapping up into the open here. Can it hold this time around?
I think this time might be different. And I don't want to be grasping for straws, but I know the last 4 out of 5 times this week we've gapped up and ended lower. I think since November we've gapped up maybe 20 to 25 times. And if you came in flat and you tried to position after the gap up, you were pulling your hair out at the end of the day because we were much lower. So the question is now, when there's a few sessions left in front of Christmas, are people pessimistic enough? Are we at a level that we're oversold that we can get a bounce? So today I think could be a little different, so I'm coming in flat. And I'm going to try and position in the first 15 to 30 minutes to see if I can manufacture some kind of trade and then maybe even trail it going into the holiday weekend.
So why is it different? Not only because sentiment is so negative and you think traders maybe are just pulling their hair out. What else is going on?
We've been using these Fibonacci retracements to try and measure some type of support to these moves. Now, if you remember on October 4th, we had that outside day, and we had a very tradable, fast and furious move to 1292. And then we had to measure the pull-in. So if you look here at the chart, you will see a very similar pattern. Okay, we've used these Fibonacci retracements. I know that everyone laughs about my little bat belt, but these things work sometimes. And here you go. This was that outside day. This was that fast and furious move that we measured. And then that Fibonacci retracement that held was the 0.618%. Okay, and this was like the last line you could have held here. This is when we broke this small upper channel here to the downside or wedge. We held here. The market looked like death. And then you had that ECB news, and we had a 100-handle rally. So if you look very similar here, from that low to where we rallied up into resistance, that same 0.618% retracement came in right there. So on yesterday's low, we hit that 1202. We had 120 on the spiders. So this is why I covered my shorts. Even though the market looked like death, I said, you know what? Here's where they caught everyone by surprise. Perhaps this is that last thread or line in the sand that the bulls will grasp on for the holiday.
All right, so you're looking for this to buy this gap up then to see if it's going to have a rally. I also want to add on 2 points to your point. Bespoke said that in the last 10 years, the S&P has risen on average just over 0.4%. The week before Christmas. Also, key, we got to look to Europe also because we're seeing European banks can now go to the ECB tomorrow and get that really cheap 3-year loan. And we also had that very successful Spanish and, for the most part, Greece debt auction today. I heard some reports that perhaps it's because the European banks can go and get this funding that maybe they're the ones in there buying the bonds. That also could be very supportive, especially tomorrow.
So now from my 2 things, it turned into like 5. So now I might even go into a tier 1.5 today. But a lot of those scenarios are maybe the part of the formula that could keep this a bit sustained. And I read that 3-year ECB thing. I was like, wow, they can kick the can down the road for 3 years. Maybe that's enough. But I also thought that was interesting too. So I just think today, every trader is going to come in and try and sell the banks that close on the lows. They're going to try and sell some of these broken down patterns. But if they can't pull in the first 15 to 30 minutes, I think those shorts get captured. And I do think we have some room in some of these stocks for a trade. And then we'll have to figure out if it's any more than that as we move forward.
So let's go to the individual sectors. Let's start with those banks because as we saw, Bank of America just got destroyed yesterday in a 52-week low there. But what's the level for the XLF that you're going to be watching to see if it can bounce off of?
Well, let's take a quick look at the chart of the XLF. It's actually a little interesting that XLF is not back at the October lows. If you look here, you will see that this was that October 4th low. Then we held higher in November. We peaked out to make a lower high. And then yesterday, we did cross below that 1250 area. So at this point, I just want to see it hold up. Maybe it can get back to this resistance. But if it starts going negative through yesterday's low and Bank of America starts breaking 5 and Goldman Sachs, like we saw yesterday, I use it as a gauge all the time. Goldman Sachs, once we broke this 99, we talked about it. That's when a lot of the momentum left this group. And that's when this bounce all of a sudden got negated. And then you had 95. And now, today it's opening up a little bit. If we could trade it long versus yesterday's low of about 86.90, perhaps, at least it won't be a headwind and the market can move a bit forward.
So then financial is good to look as a barometer, but where would you be putting your money? Would it be maybe in tech, especially if it might get some catalyst or at least some juice now that we're seeing AT&T dump that T-Mobile deal? There'll just be a spotlight on it.
Yeah, well, Qs get a little bit bouncy, and when the market wants to run, I do have a few go-to stocks. If you want to look at the Qs first, you will see not much relative strength. It's still hanging around. It's still in this macro wedge. So if you look here, this has been the downtrend. Look at the low, higher low, higher low. So I think the Qs have some room to about 55, 55, 53 if they want to bounce before this whole wedge gets resolved. I do think perhaps you could look at Intel that's been so battered and bruised from, remember this ascending channel that broke to the downside, maybe buy it in front of this supported 2250. I think IBM, worth a look. Look at this move. Okay, this is when momentum left. We talked about this yesterday. I think you could buy it versus this uptrend. So if you want to be long and you're not committed, buy it versus this 182, for a bounce to 185. So it's that type of trade where it's like you buy a level versus a level and then look to see where the next resistance is and see if you have to sell it there, or maybe it powers a little bit higher from there.
And is retail also a sector that you want to be looking at? I mean, or is it breaking down here? We're having Nike after the bell, so I wonder if retail is going to be trading ahead of that in some way.
Retail has acted a bit better than the Qs. Yesterday was an ugly candle on retail. If you look at the RTHs, you will see, on the chart, it's still above this upper level. The chart's different than the others. This was that last little line to sell for momentum around 112, and this is really ugly, as far as this wide range bar. So at this point, I would say, it doesn't look any better than anything else. But if you have some favorites or having some stocks battered and bruised, Lulu's been off a lot. I think Walmart's even came in. There are a lot of things that came in that you could buy for a bounce, but not necessarily adding to your macro positions.
And then I just want to take a quick check on oil, in particular the OIHs. We've been watching that inverse head and shoulders pattern to see if it's going to play out. Is now the time it's going to play out?
Well, I got stopped out on my long in the OIHs yesterday. I've been holding it for the past week, trying to anticipate it into weakness. And when you do it into weakness, you have to be overly committed. Since I'm a trader, I can get back in. If you look here at the chart of the OIHs, you will see, there were two spots to get stopped out. One of them could have been right here when it undercut this recent low of 112.50. I said I'll give it to the undercut of that 108, which it did yesterday. So at this point, for 2012, it's still okay because it's still in this right shoulder. Some people say it gets negated when it breaks the head. Some people think if it gives back a percentage. So in this new normal of a market where not everything is perfect, I think if you're in the OAHs and you have a tier 1 and you want to be in it for 2012, you can still be in tier 1. I might look at it as a Q trade today to get back in. But we'll see how it all unravels today.
And I also want to point out that oil's also trading higher today, and if the markets go higher, then oil's going to do well. In particular, we're going to have a higher euro, weaker dollar. That's also going to be helpful. There are also some fundamentals you want to key into. We're seeing riots in Kazakhstan, so that's going to make perhaps a supply crunch. We're hearing production is shrinking in Iran. We have a big oil company, state-owned oil company in Iran, saying that it's the result of insufficient investments in the oil fields, so we might see production slow down there. So these things are going to also be supportive, especially for Brent. So keep that in mind.
There you go.
Okay, and we're going to be right back after this. We're going to talk about IPOs, some winners and losers of the year, and how you're going to want to trade them. Stay with us.
Hi, I'm Sean Hendelman, CEO of T3Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
The IPO frenzy of 2011 is now over, Scott. But I have to say, the number of companies that went public was down 20% year on year, but they still did go public, even though there was all this uncertainty. So I don't know if that's like a bullish or bearish thing for IPOs. But in terms of their performance, 2011 saw 113 companies price their offerings, only 37 are up, and 75 are down.
Right, so that just shows you how you have to be that much more selective, and that you can't just buy a new issue for, the theme of the theme. If it's the if it's the Amazon of China, right, or the Spacebook of China, or this of that, you have to really look at these prospectuses. You have to take accountability for what you want to buy, and definitely look at the chart patterns and figure out how to trade them, because they're not all created equal, and it can be very painful if you buy the hype and not look at the fundamentals behind it.
And so before we get to the individual names, just in terms of a strategy here, we have what, the first couple days or the first hour is a trading vehicle, and then we have 2 to 3 months for the shakeout to happen, and then the retail investor can get in. What's a good time frame to look at these guys?
That's exactly right, because it all depends on your time frame. As a trader, we love when new issues come out, because if you get a hot issue, it's a great 1 to 3 day trade. Usually, we like LinkedIn as an example. Okay, the stock opened up, I think, around 90, pulled into 88, and then our strategy is once it trades back above 90 in the first 15, 20 minutes, you could buy it there with a stop at 88 and then trail it for the day. And that day, I think LinkedIn went to 120.
Right.
And then sometimes you get a follow-through day. So for traders, if there's pent-up energy and there's action, it could be a great cash flow vehicle. But then for investors, usually it takes 3 months, 6 months, sometimes even 12 months for the right pattern to build for the nice institutional support that you want to see in order to develop a pivot that you could buy against for a little bit of a longer term trade.
And LinkedIn is a great example because it's trading above its IPO price of $45, trading in the 60s, but half of that high we saw on the first day. So what does that mean? How do you interpret that? I mean, it did have its first quarterly loss since going public, but revenue doubled. So it just shows that they're spending so much more than they're actually making.
It just shows you that also that their model hasn't been proven yet, that they can make cash flow and be profitable and justify the valuation. I think everyone's wanted LinkedIn to do well, so this way all the investment bankers can get paid for all the other issues that they're going to put out there. And obviously, LinkedIn will probably get in everyone's eyes once we get closer to Facebook, so they want to make sure Facebook happens. So there's also like a timing mechanism there. So if you do look at LinkedIn, here's a chart. You will see a lot of different types of trades here. What's also good is sometimes you trade from patterns. So this was that first few day move, so that's why you want to get away from it afterwards, because then it just trickled lower. Then you had a descending channel, and just show you how you could time it. Once it broke above this 70, you had to move back to about 110. So a nice trade. Then it tried to hold up and broke. Then it's been really noisy, and now I'm looking at another descending channel here. So if you're not in LinkedIn, and it continues to go sideways here, as we get closer to them talking about Facebook, maybe you get a nice trade if it trades back above 70, for a move back to the upside. So for right now, maybe you could be in tier 1 versus this low here that was set above 55. And then I think traders will look at it if it starts to get above 70 for a move higher, so they could create some excitement about some other new issues, especially Facebook.
But if you look at one, say, a Fusion.io, its ticker FIO, biggest customer, speaking of Facebook, is actually Facebook. I've been hearing a lot about some short interest here, a lot of short interest building up, which is, I think, something that happened in LinkedIn in the beginning. Also, a lot of traders I heard wanted to short LinkedIn because of that huge run. And then now we have this big short interest for Fusion. Do we get a short squeeze, though, instead of another leg lower?
I think traders were waiting for that to happen, and then all of a sudden you get the lockup period over so people could sell. Then I think they had a secondary, so they actually crossed out some of the short sellers. So another one where you have to really look at the action and the patterns here. And there were some people that made money with this, both long and short. If you look here at FIO, I know we're looking at it right now for a potential bounce. Same type of, look at this pattern, very similar. This was that first day, had to move up. Then you had a descending channel. This was your buy, right, 2160. Then you had a big move to new highs, which was probably one of the first IPOs that made new highs in the first year. And then if you look even closer, it did go sideways, little head and shoulders pattern, broke below, and now it's right back to that area from the descending channel. So I think it's worth a look to see if you get some kind of buy strategy or buy setup, some kind of reversal here like this. So I think this is worth looking into the first quarter because a lot of it got out of the way, and this is a decent entry point.
And then two stocks in two totally different zones. We have like the Dunkin' Donuts and the Groupons. And the reason why I put those two together is because they're right around that IPO price, right? But you have a Dunkin' Donuts that didn't have a really great quarter, but you have Groupon that's not making money. So I mean, what do you do?
I think Dunkin' will have a future. I think if you could stay the course with this, I know they had a secondary. I think they had some problems with their deal. I know that they have a very solid business model. They make money. They're still growing. If you look at it right here, I do think that it hasn't been a great new issue. Once it looked really good and looked like it was going to go, I remember talking about it this day. They announced a secondary, and it failed. And now you did see a small outside reversal day right here earlier in December. So I think you could be a buyer of this versus a 23 tier 1. If it starts acting better, at some point I know I'll be talking about it if it could ever clear 29 at some point in 2012. I think that this one is something better to turn to, buy it here versus that low from early December.
And versus like a Groupon?
Groupon, you don't know. Groupon ran all of these kind of air stories or these story stocks. Groupon, I think it will get some excitement because they're going to want to get out Facebook, and they can move this around. It's a small float. If you look here at the the chart here, there's been some moves also. Look at this. This was a drastic move lower, and you could have seen it technically once it broke this area, it got crushed. And now it bounced right back to it. I do think that I'll be watching this also coming into the new year. If you had to be long some versus this little area, you better be out of the way if it breaks. But I think traders will look to this if it could start breaking above this descending channel, because there is a lot of people short here above 24, maybe you get a trade back into this high area, but it's only for the the quick active trader.
And we don't have a ton of time, but I did want to highlight the two IPOs we did see last week. Michael Kors, on the one hand, popped 20% that first day, closed slightly low on Friday, but then up over 3% yesterday. The difference here is high-end retailer makes money.
Right.
Total revenue for fiscal year 2011 was up 58% year on year versus a Zynga. 94 of its revenue comes from Facebook. Stock IPO'd at 10. It's below that now. One analyst even has a price target of $7, which is a 30% downside from its IPO price. Again, we're seeing you need to make the money, prove yourself versus the more skeptical.
Exactly.
Stocks.
And in this environment, these story stocks and the stocks that don't have their earnings stream, they're getting punished. And I know the investment bankers might be making money getting it out. Zynga was such a disappointment. My guys were waiting to trade that for it to come public. It violated every one of the rules in the beginning. I think it opened up around 980 and then never got above that high and just trickled lower, and now it's in a void. If you look at the chart here of Zynga, there's really not much to look at here.
Wow,
it needs a lot of time. So at this point, just strictly avoid this. As far as Michael Kors, I like the fact that it actually has a business model, it makes money. I think my wife has the perfume on the bathroom cabinet. I do still think it needs a little bit of time. Let it build a base, let it go sideways, and at some point, perhaps if it gets above 25.20 or the IPO high, you can get a trade. But if it happens in the next 2 to 4 weeks, it's just for a trader. For an investor, I think you got to give it at least 3 months to get that pattern intact so you can see where the institutional support is.
All right, 5 stocks, 1 minute. Let's see if we can do this here. All right, Apple, what do you want to do? Good short now?
Apple's up $3.50 today. I tried shorting it yesterday. I think the forces at will are here just until the end of the year. Watch 388 to 390 as resistance. There's some room up to that level if you want to try and position today.
Bank of America closing under that 52, or making new 52-week lows yesterday, now opening higher from that level. What do you do?
I'm just going to watch that for psychological purposes. If it could stay above 5, maybe the market rally stays intact. If it starts breaking below 5 again and below yesterday's low, people are going to start selling the banks, and there's going to be fear all over again.
Under Armour down almost 3% yesterday. Do you think we're going to see buyers come in here if retail holds up, or is there more downside?
Let me take a look. This has been a strong stock. It has been a go-to scenario. I think that it's coming into some bigger support right here. You have a high, lower high, broke the momentum area right around 78. I think it's worth a look. Versus yesterday's low. It did close in the low, so 71.80. I think if it could hold up in the first 15 minutes, you buy it for a trade. But then there's going to be so much resistance here. It needs time to prove as far as macro investing.
What about Caterpillar? Closed slightly higher on Monday. Is this a good stock to play this bounce today?
It couldn't get through the resistance, and then it kind of held support. If you look right here on the chart, I think it was a little. Oh, this is very iffy, guys. I would be very careful.
Okay.
No, I'm just saying it might get a little bit of a bounce today, but you see this channel right here? It's caught in this. It's at the lower end. If it can't get back above this 91.50, I think this will tell you how weak this market really is.
And I want to run out here with General Mills reported earnings before the bell. Earnings was pretty light. Revenue beat, reaffirmed full year guidance for its year ending in May 2012. There was also some chatter. There was some gross margin chatter. Sales were going to be up, double digits, but it just seemed to be a little noisy. What's it down, and how would you be trading if you would be trading?
I think when I looked at it before, it was down like 1.5%, and it's still been acting well. It's been chosen as one of the stronger ones. If you look here on the chart, I think in order for it to be constructive, it needs to hold this moving average. So if it could stay above this 39, which is where I saw it before, the news didn't look that bad. But if they start just selling it off, that means that nothing's holding higher. And then you have the 200-day all the way down here. So I would watch this 39 and a quarter area to see if that's viable in the first 30 minutes.
I just meant noisy because if you look at it, its second half for 2012, gross margins as a percentage of sales going to be below 2011 levels, but double-digit growth in net sales. That to me is just a little confusing. So.
Yes, I think so. The market will try and figure it out today.
Okay, so wrapping it up here, I guess, Scott, yesterday you said, less is more.
Yes.
Do you still feel like that today?
I do, and I think I'm not going to put myself fully at risk, but I'm going to try and, if they can't pull the market in, I'm going to try and position in some positions, buy a little bit, but I'm not going to get stubborn because yesterday, I know a lot of us tried to short the open and it took about an hour and then finally the market gave in and got crushed. I do think this is at a level enough where everyone's going to try and short it. I'm going to try and buy it, but I'm not going to be stubborn, and if we start falling apart, I'm not going to just chase those shorts. I'm just going to get out of the way and go study for my Series 24.
Less is more. Be flexible. Don't be stubborn. All right. Well, that's it for us for today. Happy trading, everybody. I'm Alix Steel from The Street.